You know, when Warren Buffett speaks, the financial world listens. And right now, he's sending out a warning that's hard to ignore. Get out! Warren Buffett doesn't do anything by accident. Every move he makes is calculated, deliberate, and based on years of experience. That's why his recent actions are not going unnoticed. For the first time in years, Buffett is saying it's time to get out. And he's not just talking, he is acting, pulling out billions from the market. In this video, I'm going to break down the exact reasons why Buffett is issuing this warning, what signs he's seeing, and what you should do in this situation. Because if someone like Buffett is taking a step back, it's not just a suggestion, it's a flashing red light. It all started with Buffett's The Ultimate Safety Net. Warren Buffett is famous for his investment wisdom, but what he's doing with his money right now might be the biggest hint that something's brewing. He's sitting on a cash pile of $277 billion. That's more cash than the GDP of some entire countries. But why is one of the greatest investors of all time hoarding cash instead of investing it?
First up, how about activist investors? We have seen a rise of activist investing. Carl Icahn, Bill Ackman, who was actually here this weekend. And I just wonder what the three of you think about activist investing. Is it a good thing for America or not? Charlie?
Well, sometimes it's good and sometimes it's awful. Good and sometimes it's awful. And I'm afraid that's just the way it is.
Bill, what about you? What do you think about it?
Well, there's a level of discipline that shareholders, in the hierarchy, they should be viewing the actions of the board and management. Sometimes it seems to get focused on very short-term things like the dividend policy as opposed to the strength of the management team and the long-term strategy. But shareholders having power is a very important part of the system.
What we're hearing here is a broader discussion about the market environment and how the smartest investors in the room think about corporate decision-making and long-term strategy. Notice how Bill Gates points out that shareholders often get caught up in the short-term issues, missing the bigger picture. This ties directly into why Buffett is sitting on so much cash. He's looking beyond the short-term noise and staying disciplined, waiting for the right moment to strike. Buffett isn't interested in chasing after the market's short-term gains, nor is he swayed by the pressures that many investors face to act quickly. Historically, Buffett has always been eager to invest when others are fearful, but this time he's taking a different approach. His cash reserves have grown massively, from about $122 billion in 2019 to $277 billion today. That's more than doubled in just a few years. This suggests that Buffett believes the market is overpriced and that there aren't enough bargains out there. Think about it. Buffett's entire investment philosophy is based on finding undervalued assets. And right now, he's saying there aren't any. He's choosing to sit on his cash until he finds opportunities that align with his long-term investment strategy. Both Munger and Gates share this approach, highlighting the importance of maintaining a clear, disciplined view of the market rather than succumbing to short-term pressures. But what does this mean for everyday investors? Well, if Warren Buffett, with all his experience and resources, isn't seeing good opportunities, maybe it's a sign that we should be cautious too. It might be time to reconsider throwing money into an overvalued market, or to think twice about chasing the hottest late stock and get out of weak positions. But holding cash isn't the only indicator that Buffett's concerned about with the market. There's another key metric that he's watching that's flashing a warning sign, and that's called the Buffett indicator. If there's one tool Warren Buffett trusts to measure the health of the stock market, it's his own creation, the Buffett indicator. And right now, it's flashing a warning signal that we haven't seen in years. But what exactly is this indicator, and why should you care? The Buffett indicator is simple but powerful. It measures the total value of the stock market relative to the country's GDP. Essentially, it tells us how the market's value compares to the overall size of the economy. Historically, when this ratio gets too high, it means stocks are overvalued, and a market correction could be on the horizon. As Warren Buffett said, when the total market cap to GDP reaches unsustainable levels, it's usually a sign that trouble is brewing. It doesn't mean you know when, but it's often a precursor to major corrections. What Buffett's saying here is crucial. He's not trying to predict exactly when the market will crash, but he knows from experience that when the Buffett indicator hits extreme levels, bad things usually follow. And guess what? As of now, the Buffett indicator is at around 210%. That's higher than the dot-com bubble in 2000 and the 2008 financial crisis. So why does this matter now? To put this into perspective, during the dot-com bubble, the Buffett indicator hit about 140%, and the market eventually crashed. During the 2008 financial crisis, it peaked at around 110%. Today, at over 200%, it's telling us that the market is more overvalued than at any point in recent history. If Buffett thinks this is a red flag, we should be paying very close attention. And here's the kicker. Buffett isn't just talking about this, he's acting on it. He's building up his cash reserves, selling off stocks, and being extremely cautious. This is someone who usually thrives in market downturns, and yet he's holding back. That tells us everything we need to know. One of the clearest signs that Warren Buffett is preparing for something significant is his decision to sell off a substantial portion of his stock holdings. This is particularly surprising because Buffett is famous for saying, "Our favorite holding period is forever." So when he starts selling, especially his most valuable investments, it's a wake-up call for the rest of us. Buffett's recent decision to reduce his stake in Apple, his largest single holding, caught many people off guard. It's a company that has contributed immensely to Berkshire Hathaway's success over the past few years. Yet, Buffett chose to sell some of his shares. But why? Well, to understand Buffett's reasoning, let's just hear it directly from him.
All right, Warren, earlier you talked about selling some of the Apple shares in order to build up your cash supply, and I think it's had a lot of people wondering where you see opportunities or what might be coming or market valuation. So I'll ask this question from Foster Taylor. At the 1999 annual meeting, you mentioned that if you owned all of America's 500 businesses, you would be making $334 billion while paying $10.5 trillion. You emphasized that this was not a good return on investment. Today, by my math, the S&P 500 has a market capitalization of around $44 trillion with profits of around $1.45 trillion. This is a very similar return on investment to the 1999 levels. Do you see similarities in the market today and the 1999 levels?
Well, one thing has changed dramatically from 1990. I misunderstood on the 1999, but there have been times in my life that I've been awash in so many opportunities that I could have invested everything by nightfall. And then there's other times when the year goes, well, not in the early days, but now, we just we haven't seen anything that makes sense that moves the needle. Now, we've made small acquisitions during the year. Our companies have made acquisitions, and we, Greg and I may talk about something that involves a $300 million purchase or something like that, and if it fits well enough, we do it. But and if our managers see things that fit them, we want to look at them because our managers do not have necessarily the same equations in mind that we do. But there's some managers which we would end up just say, whatever you decide to do, and then there's other managers that would not know how to allocate capital particularly, and that they don't have to be able to be great capital allocators if they happen to be great at serving customers and understand their own industry and all of that. They can be great managers, and a good many of them aren't capital allocators, and others are. But this is not a time when the phone is going to be ringing often, but there are times from that, and Greg will know how to handle them as well or better than I have over time. And Charlie and I would, we missed a lot of things, and what we really regretted was missing something that turned out to be very big. We never worried about missing something that we didn't understand. I mean, why should we be able to, predict the future of every business any more than we can predict, what wheat yields are likely to be in Illinois next year? Well, not wheat in Illinois, wheat in Kansas, but corn in Illinois. I don't really think of whether it's similar to 1999 because I'm not that good on chronology anyway, unless something really dramatic happened at the time. I mean, I remember things from 2008 and 9 much better than I remember whether something happened in 2015 or 1987 1987 I remember because of October 19th. I just don't think that way. I just look at what I can do every day. Greg?
What Buffett is essentially saying here is that there are times when the market is overflowing with opportunities, but today isn't one of those times. Despite holding billions in cash, he's not seeing enough investments that meet his high standards. This highlights a crucial point. If Warren Buffett, with all his resources and expertise, isn't finding good deals in today's market, it could mean the market is overvalued. Buffett is telling us that even the best companies can become dangerous investments if their prices are too high. It's not that he doesn't believe in Apple anymore, he's just being prudent. He's recognizing that the market might be getting ahead of itself, and he's choosing to lock in profits before things potentially turn south. His decision to sell Apple isn't a reflection of his lack of confidence in the company itself, but rather a sign that he believes the overall market is reaching dangerous levels of valuation. This aligns with the idea that sometimes even the best investments need to be reevaluated when the market conditions become unfavorable. But it's not just Apple. Buffett has also been trimming his positions in other major holdings, including financial and energy stocks like Bank of America and Chevron. This shift indicates that Buffett is choosing to de-risk his portfolio, building up cash rather than keeping his money tied up in an overvalued market. In his response, Buffett also emphasizes that while there have been times in the past when he was flooded with great investment opportunities, that's not the case right now. He points out that it's rare to find assets worth investing in that move the needle for Berkshire Hathaway, indicating that the opportunities today simply don't justify jumping into the market with both feet. Also, if you've been paying attention to financial news lately, you've probably heard about rising interest rates. But what does this have to do with Warren Buffett's warning? Well, quite a lot actually. In fact, rising interest rates might be one of the biggest reasons why Buffett is becoming increasingly cautious right now. When interest rates rise, borrowing becomes more expensive. This affects everyone, from individuals with mortgages to corporations looking to finance their operations. Higher rates can slow down spending, reduce profits, and ultimately drag down stock prices. And that's exactly what's starting to happen.
Let's talk a little bit about what Joe was just mentioning. I had not seen the 10-year yet this morning. He talked about how it's at 2.57%. Why do you think that is? Is this a sign of concern about what's happening? What would be your guess?
I don't know. I'm no good on interest rates, but the one thing I know is 10 years from now, they won't be at 2.57 or probably at 3.57.
Does it catch your attention, though, when you see the 10-year continuing to decline? Because most people thought it would definitely have to go up this year.
Yeah. It's surprising, but I'm used to getting surprised in markets. And we issue bonds from time to time. So the lower rates are, the more we like to issue them, and the longer we like to issue them.
Munger is pointing out something incredibly important here. Because rising interest rates don't just hurt companies' bottom lines. They fundamentally change how investors value assets. When rates rise, the value of future cash flows decreases, making stocks less attractive. This can lead to a sharp correction, especially in a market that's been used to historically low rates. Warren Buffett isn't just sitting around waiting for the impact of these rising rates to hit. He's actively repositioning Berkshire Hathaway to protect against potential losses. This explains why he's been reducing his exposure to financial stocks like Bank of America, which tend to suffer the most when interest rates climb. But it's not just about the US interest rates. Buffett has been paying close attention to what's happening in Japan too. Over the years, Japan has maintained some of the lowest interest rates in the world, making it a prime place for what's known as the carry trade. Investors would borrow money at low rates in Japan and invest it elsewhere, like the US stocks. Buffett's warning is clear. The days of ultra-low rates might be ending, and that could trigger a massive shift in global investment strategies. If interest rates rise in Japan, it could lead to a sell-off in U.S. assets as investors look to repay their loans back home, putting even more pressure on the U.S. stock market. Matter of fact, he is already liquidating his yen-denominated bonds.
And over that time, we've sold periodically yen-denominated bonds. So more or less, we don't do it precisely, but we've insulated ourselves from exchange rate changes. So it's worked out very well so far, but we'll be in these stocks 10, 20 years. I mean, we weren't buying with the idea they go next week, next month, next year. But we have had revelations about each of the companies that, Greg and I are just fascinated by it. Right?
Warren Buffett's history of navigating market booms and busts is a blueprint. During the dot-com bubble and the 2008 financial crisis, while others rushed into risky investments, Buffett stayed on the sidelines, avoiding the mania. He waited patiently, and when the dust settled, he swooped in, buying valuable assets at bargain prices. This strategy wasn't luck. It was the result of a calculated and disciplined approach, traits that have defined his investment philosophy for decades. In his own words, the stock market transfers money from the impatient to the patient. Right now, Buffett's actions mirror his cautious approach from these past crises. He's building his cash reserves, selling off overvalued stocks, and waiting for the right opportunities. It's a clear signal that he believes a market correction is coming, and if we're smart, we should be preparing too. Buffett's actions suggest that getting out of the market right now might be the wisest move. Having cash on hand isn't just about safety. Getting out of the risky, overvalued investments is a priority. Want to know how to turn a $10,000 investment into a $500,000 portfolio in this overvalued market? Click the video on the screen to find out.